be here. So at Sprott, our vision is to be the leading global investor in gold. And we like to think of it as going right from one end of the interest curve, which would be just investing in the commodity itself, to the other end, which would be investing in highly specialized, illiquid strategies in the sector. But what we get asked about the most these days is what's going on with Bitcoin, sorry. And the reason for that is it's become probably one of the number one financial stories in 2017. It's now, it and its brethren have taken about 200 billion of market cap. And I guess paradoxically, the philosophy behind the cryptocurrencies is the same as gold, but for at least the younger age investors, the millennials, I think that the quote was that 90% of all Bitcoin is owned by investors under 40 years of age. For the younger investors, this has really taken some serious market share. So we've dedicated some decent amount of analysis to looking at Bitcoin and looking at the blockchain and also comparing it to gold. And I don't think there's any comparison in terms of the liquidity and the trust factor that gold is associated with, but certainly digital currencies have become very popular for both trading, from a trading perspective, and they do have an advantage in that they don't require somebody to know their client when they're buying Bitcoin. What I'm meant to underscore for this conference is things are going to change for gold, and I think gold is going to tap into this trend through innovation, and we're reasonably sure it's going to happen over the next couple of years. So I'll just underscore a few points first. Gold is a very liquid currency, contrary to criticisms about it. It is the fourth most highly liquid traded asset on the planet. And I think the statistics, depending on how you count them, are anywhere between $50 and $70 billion per day. It's also had an undeniable performance track record against other paper currencies. So if you take a look at this chart, just going back over the last 15 or so years, that is a great performance track record. Not as good as Bitcoin this year, though. So what's going to happen with gold is that new entrants are going to digitize gold and have already started digitizing gold for both retail customers and for institutions. We were early investors in a company called BitGold, and a company it's now changed its name to Gold Money, which provides a competent mechanism for a retail investor to hold gold in a Brinks account and exit and spend the gold through the financial system through MasterCard and other means. What will happen going forward, and which will be significant to gold, is that gold will become digitized and backed by the blockchain. And what this will do is increase the trading speed at which gold will transact, and it will also be available to be put into various accounts in the financial system and outside of various accounts in the financial system. So these are some of the players in that market, including our own entrant. And we have very high hopes for this part of the sector. So it's the innovation that I don't think the gold market has properly captured. And it's not that different when you think about it to the innovation that occurred historically. Gold, when it was available only in coins, probably had a 5 to 10% friction level associated with it, the minting of those coins, the buying of those coins, the holding of those coins. As gold became stored in bar format, it became less expensive to hold, and commercial banks got in the business of storing gold. And then gold went on the exchange through the GLD and the other ETFs, including our own physical trust at Sprott. And the holding cost for a retail investor fell to 30 or 40 basis points across the board. Well, this innovation will take gold storage costs to extremely low levels. And I think will make it a more popular currency for younger people, a more popular currency to be used in payments, a more competent and popular asset to be held in accounts. So just to highlight Tradewind's markets, we have our initial vaulting arrangement with the Royal Canadian Mint that's supporting the company. We have market technology powered by the IAX exchange, which has a very trustable on-exchange bidding and quoting system and can also tie into financial institutions globally. We have producer support. We have marketing and distribution support. This is a digitized statement of claim for a piece of gold at the Royal Canadian Mint that can be traded through any internet account that is hooked into IEX. The team has lots of experience, both technologically and financially, and we look forward to launching this in the first quarter of 2018. So, I changed the subject, and just to underscore for a few seconds why we still believe in gold. And I think that to a certain extent, it's not become a very popular asset in the last 5 to 7 years, but the underlying reason for holding it has not changed. The total amount of global debt in the system is not being well supported by GDP. And this is what we think will eventually lead to hiccups in the system, which will prove gold as a good alternative currency and a good hedge against this financial market system. Real assets, including gold, are at all-time lows versus financial assets. So in terms of the optionality, the value, the cost of that hedge, it has never been cheaper relative to the potential gain. In terms of the revolution that's taking place and that we're in the front row for, I think what is happening to the gold sector as we have gone through the past 10 to 15 years is the sector is becoming easier to invest in, it's becoming more institutional, and slowly but surely the producers are changing their ways and becoming more shareholder-centric enterprises that are more worried about delivering profits to their stakeholders. Gold equities have historically provided 3 times the price leverage to a move in gold than bullion itself. The industry, which was evolved from a combination of very, very heavyweight senior companies at one end of the spectrum and very, very junior speculative companies at the other end of the spectrum, has now evolved. It has evolved from promotion to delivery, and history and regulation have slowly but surely enforced discipline. So what we're seeing out there is credible teams doing credible things on very complicated projects with a focus on shareholder returns. Very different than what was happening 10 to 15 years ago. Costs are, as a result, predictably perhaps falling, and margins to shareholders are increasing. This makes the sector more investable by a wider variety of investors. And increasingly, sophisticated investors are using gold as a portfolio diversifier. I think the World Gold Council has done a great job in outlining a case for gold as a portfolio diversifier and value-added component to any investment portfolio. Increasingly large, some of the world's leading, most sophisticated investors are allocating very heavy percentages of their portfolios to gold. And for the first time, what we're seeing on the front lines is large endowments making first-time allocations to gold. Investors who previously didn't believe in the sector, didn't believe in it in terms of being end of the earth type investors, or those who thought they wanted a hedge, they're now investing substantial quantities in gold. a good example is some of the state funds and some of the universities in Texas who hold it as large percentages of their portfolio. And yet, gold equities are still underperforming gold itself. And we call these two charts, both gold equities versus gold and gold equities versus other S&P equities, we call them the jaws of life, because for us, this is what the trade in gold equities is all about, is how are gold equities valued compared to other financial assets. And that chart has been opening up over the last 4 to 5 years, and is now, especially against the S&P stocks, as wide as it's ever been. And this is where the leverage is in the trade. Gold stocks are very cheap on a long-term basis against financial assets and against their 25-year ratios. And again, here's the other jaws of life against the S&P stocks. That is cheap optionality now. And again, we're seeing more and more investors that are interested in allocating percentage of their portfolios to this. So the sector's evolved a lot, and I don't think it's getting a lot of credit. And a lot of people asked us, well, why are the stocks so unpopular, and why can't mid-cap companies in particular get any traction with investors? And it's pretty simple, I think. Behind the scenes, there have been massive changes to the financial sector, which have involved indexing and which have involved distribution advantages for indexers, which have taken all that interest in the sector and driven it into the large liquid companies. And this is a trend that while it's still strong and will still have some momentum, we think has probably gone as far as it will possibly go. As a result, a lot of the mid-cap equities have been left behind and are faring far worse than this general chart here. And I think that there is now excellent value offered in those mid-cap companies, and we're looking to exploit it as much as we can. It is difficult for an asset manager like ourselves to gain flows to those equities, because even we are seeing most of our inflows in the larger indexed funds. The alternative for us has been private equity style vehicles, LP, dedicated LP type vehicles. That's where we are getting inflows as well. But that involves a more balance sheet centric strategy. So we're investing in project finance and project finance credits, and we're investing in large, almost controlling positions, 10, 15, 20% positions. It's still very hard for us to get flows into our general gold funds, our mutual funds. And those are the funds who have traditionally held the smaller cap companies. So I guess I'd just open it up to questions. Be happy to take any at this time. Quiet room today. Yes.
Hello. Do you invest in Australia? What do you think to Pilbara area?
Yeah, we have very heavy investments in the Australian markets. Are you talking about the areas around the Novo Resources?
Yeah.
Yeah.
Have you heard of Greatland Gold?
Sorry, which company?
Greatland Gold.
No, I haven't heard of that one ourselves, but our founder, Eric Sprott, who invests for his own family office, is the heaviest shareholder in a lot of those plays. He and his technical staff believe that there is a very large technical picture there for large gold systems, and so they've been early stage investors in a lot of those companies. I realize that those are prospects at this time that still need to be drilled out, but they've got a lot of technical people on their teams, and I believe Kirkland Lake Gold has also made an investment in Novo Resources, so we're watching that very closely. Our funds have made some investments, but very small to date.
Newmont Mining have got an exclusive deal, 6 months, with Greatland Gold, and they're in that area as well.
Yeah, a lot of big, technically minded investors are looking at it now. I was aware of that.
What about Romania? Have you invested anything in Romania?
Romania. We were previously shareholders in Gabriel Resources. We knew the project and know the project quite well. Obviously, it's been a tough political road to get things permitted there. I realize there's a couple of other projects that are advancing. We like the geology there and have kind of taken a wait-and-see attitude until we see projects being permitted.
Right. It's supposed to be big in copper and zinc.
Yes.
Thank you.
Yes.
Talk a little bit about your revenue in the sector, what you anticipate going forward, and I guess obviously Canadians have to replace reserves and they have to cease their production declines. It seems like an obvious answer, but on the other hand, you have investors telling them they have a horrible track record of what to do it. So I guess what's your personal view of them making acquisitions, and do you see that happening in the future?
Well, this is an area where we hear it's the big year for M&A every year. And I think that's because there are great reasons for it. There are great reasons to have a lot of M&A. First of all, capital budgets have been constrained for 5 to 7 years. As I mentioned before, shareholders are much more focused on return now. So there's been a lack of spending, and reserve lives are generally getting shorter as a result. It's also getting harder to produce. So there's this great reason for M&A. Sorry, I should mention one other point, and that is G&A as a function of NAV is, as always in the sector, very high. So we have all these individual teams running probably less than perfect portfolios, running 1 or 2 mines with large G&A. And so M&A can cure that by achieving the synergies of scale. On the other hand, there's a lot of personal interest at stake protecting individual corporate situations. And I'm not just talking about shareholders. I'm not just talking about managements. I'm talking about shareholders that believe they are always the ones that should be receiving 70 and 80% premiums over market. And management teams as well, who always believe that their projects are better than what they see across the data room. So it's those two conflicting forces that go to work in any given period of time. I think there's pretty good reason to suggest that M&A should be happening at an increasing pace going forward. And if for no other reason than what I talked about before, the passive funds can't invest in small companies. You need these companies to get larger to attract the attention of generalist investors. Yes?
Hi, Peter.
Hi.
I wanted to know if you could highlight the difference between the new product you're going to be rolling out in Q1 versus, let's say, what was BitGold, and how you might market them differently, or what you see as the strategy for that new product.
Okay. This is a technology product. It's not an asset management product for us. We don't charge a fee on this, and neither does the Mint charge much of a storage fee. What pays for the system is the trading on exchange, and what pays for the system is the ability to generate small premiums to NAV. So investors will pay very small premiums to NAV because it's the most efficient way to trade and store physical gold. We don't know how much that system will pay yet, and we don't know how liquid that system will be. We don't know how popular it will be. The difference between that and BitGold or Gold Money or related systems, we hear there's others in the UK and others in China that are being brought to market now. Those systems have a very specific customer proposition. You give us your money through a pipe, Visa, debit, however else. You give us your money, we store the gold for free, and then we charge you when you take it out. It's a lot more specific related to a retail transaction. It's essentially a payment and storage system. This is not. This is simply ownership that exists out there, and we'll have to see how much it's used. It's just the killer app in terms of the cheapest way to trade and to store gold, and the fastest way.
So really, you're substantiated by the Royal Canadian Mint as far as, credibility of where the metal is. That's really...
For the time being, the Royal Canadian Mint will be the storage site for us, but if this system starts to populate, we're going to have to pick city vault locations elsewhere so that if people want to access their gold, they have a physical location they can get at quickly. The gold market is, I believe, a $5 trillion market. Central banks own over half of it. Trades 70 billion a day. This could be absolutely massive. Could be absolutely massive financially. Yes?
I was going to ask whether you had other assets which you thought were correlated with the gold opportunity. Okay, yeah. I was going to ask you if you had any other assets which were correlated with the gold opportunity you talk about. I mean, there's silver, precious stones. Are those areas where you think there's investment opportunities of a similar magnitude?
Yeah, absolutely. We do a lot of research into production situations in silver, platinum, and palladium, very closely related to gold. Also, financially driven metals, although they have a significant industrial component. It is a reality that for a mining fund, a mine's a mine and a margin's a margin. So we look at other situations. We look at copper. We look at battery technologies and battery materials. And I think all of those are interesting areas. All of them have suffered from underinvestment. All of them have suffered from lack of inflation. All of them have upside, but they're more economically driven. And the reason why we're more interested in precious opportunities is precious opportunities are counterweighted to the economy. So that's kind of what we want to offer our investors. So we always weight our firm towards gold and silver in particular. I think on the subject of silver, it's increasingly difficult to find pure silver plays in the world. Most of the great mines are really, combination lead, zinc, silver mines. And silver is a much smaller market. So when you do get tension that makes gold go up, silver always goes up more. So it's pretty interesting at $17 an ounce. Okay, well, it looks like that's it. Thank you for your time.